Hey, so every Monday, including this one, because why wouldn't you include this one if it's every Monday? You write a column for the Center Square. It's the Everyday Economics column. You look ahead at what's coming up this week. There's a lot of interesting stuff going on. Let's talk about the lead, and then I absolutely want to talk about we're going to get a lot of direct from the Fed conversation this week. We've already had one visit. Chairman Jerome Powell speaks today. I don't mean to tease too much. We'll get to that in a second. But let's talk about the jobs report. So in the Everyday Economics column that you published today, you're talking about the April payroll coming in. Of course, this data was released, was it last?
In May, early May.
Yeah.
A month ago.
Yeah. Okay. Right. Yeah. Forgive me. It was a month ago. And so we're waiting on new jobs report data, which we should see relatively soon here. So you're kind of going backwards a little bit, but this is what you wrote. You said April's payrolls came in stronger than expected, rising by 177,000 jobs, beating the consensus forecast of 130K. However, that headline number masked a softer trend. Prior months saw significant downward revisions, with March and February payrolls lowered by a combination of 58,000 jobs. Accounting for these changes, the underlying pace of growth has slipped to an average of about 152,000 jobs per month over the past year. Okay. All right. So,
which is, by the way, slightly lower than the pre-pandemic monthly average, right? So you could argue we're back on pre-pandemic pace. And the question is, are we going to slip lower, even lower than that, in upcoming job reports?
Okay. So what's the significance of it? I mean, I understand the statistics, and the statistics make sense. But where's the puck headed on this? What's your feeling? You're getting to something here. I don't want to take the column away from anybody, but I think it's maybe at this point I think spoilers are okay. Well, what are you getting at?
Well, the bottom line is the economy is slowing, and the economy is slowing. People are staying unemployed longer. All you have to do is look at initial and continuing claims, unemployment claims. Initial claims remain low, and that's been the argument for a long time. But then when you look at continuing claims, they've been ticking higher and higher and higher. And if you think about what that actually means, it means Americans are staying unemployed for longer. Unemployment duration is rising. And if you take the total, I think of initial claims and unemployment claims, initial claims being the flow into the pool of unemployment, right? The new people getting claiming unemployment benefits, plus the the number of people that were already claiming unemployment benefits that are still claiming unemployment benefits. And you end up with basically the net flow, right, into unemployment plus the stock, right, the total stock. So you get the full flow in and out of unemployment by adding those two things together. And what that looks like is it's the highest level since October 2021, when the unemployment rate was 4.5% compared to 4.2% now. And essentially, what am I saying? I'm saying, look, the unemployment rate could be at a turning point. We could actually be seeing the labor market soften enough to result in a jump in the unemployment rate in next month's report, potentially. This month's report is all written already. Next month's report is going to probably show the last 4 weeks is likely going to be, by the way, a very good predictor of the unemployment rate is unemployment claims. And so we've had a 3 weeks in a row, continuing unemployment claims increasing. If we get another uptick this week, then my forecast says the unemployment rate could tick up roughly 0.3 percentage points to 4.5% for the next month, the month of June, which will be released in July. So you have a loosening labor market, right? You have more people unemployed. You have the unemployment rate rising. And at the same time, you have PCE inflation at 2.1%. just a hair above the Fed's 2% target. What that tells me is the Fed's about to cut. The Fed needs to cut. The Fed needs to cut at some point in the second half of this year. Daily from San Francisco Fed still said 2 cuts are probably still in the cards. We're going to find out. We're going to find out very soon because we have a Fed meeting that will also include a summary of economic projections, which will give us a hint as to what's going on in the FOMC members' minds, heads, their forecast. And yeah, I have an inflation rate easing and I have an unemployment rate rising. And to me, that means policy is restrictive and the Fed could and should maybe, cut in the second half of this year.
All right. So let's take it down to the street. And I appreciate that. That's a thorough explanation and a terrific summary. As always, you demand. I am out there unemployed right now. Maybe, my unemployment, I'm just sort of kind of like floating along on my unemployment. It's summer, right? It's about to be. Should I kick it into gear right now? I mean, as a job seeker, and maybe should I be willing to look at a job that maybe isn't A, ideal, B, isn't gonna pay maybe where I was?
Yeah, I mean, unfortunately, that's the reality. The labor market's very slow right now. Hiring rates are at a decade low. And so, it's much more difficult today to find a job, right? To get hired anywhere. And so workers don't have a ton of bargaining power. Wage growth is likely to continue to ease. And so that's what I'm looking at right now. I'm looking at a picture where the labor market is not looking as strong as it does on the surface, right? I wrote fragile beneath the surface on my LinkedIn post because that's really what's going on. We have weakness underneath and things could go in the wrong direction. And the Fed will have to step in to rescue this labor market. Unfortunately, the Fed has been on the sidelines primarily because it's unsure about the potential impact of all the policy levers that are being pulled in Washington, D.C. It's also unsure about where the neutral rate is because fiscal deficits continue to increase, right? And I think we should do an episode on that. I think part of the problem is that you have tax cuts without spending cuts is going to lead to higher deficits, and those deficits are going to be inflationary. And so that's why the Fed is likely sitting on the sidelines.
We're going to talk about that in a second. Yeah. That's the next episode that we're going to do, but you're right. You are right on. And that is a great place for us to end and a nice teaser to the next episode.